3 numbers. That is all I need you to hear in the first 30 seconds. $516. That is how much less per month a person born in 1950. 7 receives permanently for the rest of their life if they claim Social Security at 60, to instead of waiting until their correct full retirement age of 60. 6 years and 6 months, $123,000. That is what that single decision costs over a 20-year retirement. 0. That is how many times the Social Security Administration will warn you before you make that decision. They will process your application. They will confirm you understand your benefit is reduced. And then that reduced number becomes your check for the rest of your life, depending on the year you were born. Your rules are different. Your full retirement age is a specific month and year, not just a round number. And the mistakes that cannot be undone are different for each group. Today I am going to show you exactly what applies to your birth year, in real dollar terms, with the math the Social Security Administration actually uses. Find your group. The information specific to you starts now. Everything in this video comes directly from the Social Security Administration's official benefit reduction tables, the SSA Program Operations Manual, and SSA.gov. These are not projections or opinions. These are the precise formulas the government uses to calculate your monthly check. Here is something most people do not realize. The Social Security system operates differently depending on the year you were born. Not just the claiming age, but the exact calculation method, the coordination rules between benefits, and the options still available to you. Your neighbor who retired the same year you did may have a completely different full retirement age, different reduction percentages, and different strategies available to them. I am going to break this down group by group. But first, a quick note. Social Security rules change every year. Earnings test limits, Medicare premiums, IRMA, a threshold. When they change, the Social Security Administration does not send you a personal notification. They change the policy and expect you to already know. Subscribe and turn on the bell so you get this information before the deadlines pass. Now let's get into it. Here's the core misconception most people carry into their claiming decision. They believe Social Security has 3 ages. You can claim at 62. You can claim at 66 or 67. Or you wait until 70. Clean and simple. The reality is far more precise than that, and that precision is where money gets lost. Your full retirement age. The age at which you receive exactly 100% of the benefit you earned is calculated to the specific month based on your birth year. It is not 66. It is not 67. It is one of 7 specific month and year combinations established by Congress, and if you claim even 1 month before that number, the reduction is calculated month by month using a 2-tier formula. Here is that formula, exactly as Social Security applies it, for the first 36 months before your full retirement age, your benefit is reduced 0.5% per month. For any months beyond 36, meaning if you are claiming more than 3 years early, the rate increases to 0.5% per month. These 2 rates combine to produce the per-month introduction percentages you have heard quoted. But the reason I am showing you the formula is this. The penalty is not a flat percentage. It depends precisely on how many months early you claim, and your full retirement age determines that month count. Get your full retirement age wrong by even a few months, which is easy to do if you are relying on round numbers, and your entire claiming calculation is off. Let me show you what this looks like in actual dollars, and I want to follow the people through this video to make the math concrete. First, Robert. He was born in October of 1957. His primary insurance amount, the Social Security Administration's official term for the benefit he earned at his exact full retirement age, is $2,200 per month. His full retirement age is 66 years and 6 months, which fell in April of 2024. Robert is currently 68 years old and has not yet claimed. Now meet Linda. She was born in March of 1963. Her full retirement age is exactly 67 years, which falls in March of 2030. Her primary insurance amount is $1,800 per month. She is 63 right now. Family members are telling her to claim immediately. She came here to see the math before she makes any decision. I will come back to both of them as we move through each group. Group 1. Born between 1943 and 1954. You are between 70 to 183 years old. Your full retirement age was 66. If you are in this group, you claimed Social Security years ago. The common assumption is that there is nothing left to review or optimize. That assumption is incorrect, for two specific and documented reasons. Reason 1. Survivor benefit comparison. A significant percentage of widows and widowers in this age range are collecting their own retirement benefit when they would receive more on their late spouse's record, or vice versa. The survivor benefit for a widow or widower can equal up to 100% of what the deceased spouse was receiving at the time of death, including any delayed retirement credits they had accumulated before they passed away. Here is a concrete example. A woman born in 1949 receives $1,100 per month on her own record. Her late husband received $2,400 at the time of his death. She has never specifically asked Social Security to compare both figures. The difference is $1,300 per month. That is $15,600 per year she is not receiving. The action is straightforward. Call Social Security at 1-800-77-1213. Ask them to pull two numbers, your current benefit amount and the benefit available on your late spouse's record. Then ask directly, am I currently receiving the higher of the two amounts? If you have never asked this question explicitly, there is no guarantee Social Security placed you on the correct record. This call is free. There is no penalty for asking. One additional note for this group. If you were born on or before January 1st of 1954, ask Social Security whether the restricted application strategy was ever applicable to your record. This was a strategy that allowed a spouse to file for only the spousal benefit while letting their own benefit grow to age 70. It was eliminated for people born after January 1st of 1954, but if you are in Group 1, it may still be relevant to your situation. Reason 2. The Medicare MA Surcharge Review. MA stands for Income Related Monthly Adjustment Amount. If your household income in 2022 or 2023 was elevated due to a Roth conversion, a property sale, a one-time distribution, or any event that temporarily increased your income, and your income has since dropped, Medicare may still be billing you based on that older, higher income. Here are the MA thresholds for 2020. For a single filer. If your modified adjusted gross income in 2022 was $103,000 or below, your standard Part B premium is $170.70 per month. If your income was between $103,000 and $129,000, your premium jumps to $244.60 per month. Between $129,000 and $160,000, $1,349.40 per month. Between $160,000, $1,000 and $190,000, $3,454.20 per month, and over $193,559 per month. For a married couple where both spouses are subject to MA at the middle tier, that is nearly $350 per month in avoidable premiums. Over $4,000 per year, based on an income level that may no longer exist. The appeal mechanism is SSA Form 44. You attach it to documentation of a qualifying life event, such as retirement, significant income reduction, divorce, or death of a spouse, and Social Security. Will use a more recent tax year or your current year income estimate to recalculate your premium. This appeal can be filed at any time. SSA Form 44 is available at ssa.gov. Group 2. Born between 1955 and 1959. You are between 67 and 71 years old. This is the most critical group in 2020. 6. For one specific reason. Every single person in this range has a different full retirement age, down to the exact month, and most people in this group only know the round number estimate. Here are the exact full retirement ages for each birth year in this group. If you were born in 1955, your full retirement age is 60. 6 years and 2 months. If you were born in 1956, 60. 6 years and 4 months. If you were born in 1957, 60. 6 years and 6 months. If you were born in 1950, 60. 6 years and 8 months. And if you were born in 1950, 66 years and 10 months. These are not approximations. These are the numbers Social Security uses in every calculation involving your benefit. Your full retirement age is not 66, and it is not 67. It is one of those 5 specific numbers. Let me go back to Robert. Born October 1950. 7. Full retirement age, April 2024. He is now 68. He has passed his full retirement age by approximately 20 months and has not claimed. Here is what that means in dollar terms. Every month past his full retirement age, Robert turns 2/3% in delayed retirement credits. Permanently. At 20 months past his full retirement age, his benefit has grown to $2,200 multiplied by 1.133, which equals $2,493 per month. Now, what if Robert waits until age 70? That would be 42 months of total delayed credits past his full retirement age. $2,200 multiplied by 1.8 equals $2,816 per month. That is $616 more per month than his full retirement age benefit permanently. Over a 20-year retirement, that is $147,840. And here is the break-even analysis. If Robert delays to 70 instead of claiming today, the additional monthly income gained is $316. The benefits he forfeits during those 22 months of waiting, at today's rate of $493, total approximately $54,000. Divide that by $316 of additional monthly income, and the break-even point is approximately 170. For months after he claims at 70, that puts the break-even age at approximately 84.5. If Robert's family has a history of longevity past 80. 5. The delayed is 70 is mathematically superior. If he has health concerns, claiming sooner may be the right call. But that decision should be made with this math in front of him, not without it. For people in Group 2 who are currently working and collecting Social Security before their full retirement age, the 2020 6 earnings test threshold is $23,400 per year. For every $2 you earn above that amount, Social Security withholds $1 from your benefit. This is not a permanent loss. When you reach your full retirement age, Social Security recalculates your monthly benefit upward to credit the months where payments were withheld. But if you do not understand this going in, a benefit check that suddenly drops or disappears can create serious cash flow problems. Budget for it and plan for it. Group 3. Born between 1960 and 1965. You are between 61 and 66 years old. Your full retirement age is exactly 60. 7. This is Linda's group. Her primary insurance amount is $1,800 at her full retirement age of 67. Her family is telling her to claim at 60. 3. Let us run the actual numbers on that decision. Claiming at 60. 3 means she is 48 months before her full retirement age. Here's how Social Security calculates that reduction. The first 36-month 36 multiplied by 5/9% equals a 20% reduction. The remaining 12 months 12 multiplied by 5 0.12% equals a 5% reduction. Total per month introduction. 25%. Linda's monthly benefit if she claims at 60. $1,800 multiplied by 70. 5% equals $1,350 per month. Now let me show you the full lifetime comparison. If Linda claims at 63, she collects $1,350 per month. From age 63 to 85, that is 22 years, and her total cumulative income is $356,400. If Linda waits until 67, her full retirement age, she collects $1,800 per month from age 67 to 85. That is 18 years, and her total is $388,800. If Linda waits until 70, she collects $2,232 per month. From age 70 to 85, 15 years, her total is $401,760. The break-even age between claiming at 67 versus 63 is approximately age 79. The break-even age between claiming at 70 versus 63 is approximately age 81. If Linda's parents or grandparents lived into their 80s or beyond, the delay math is decisively in her favor. Now here is an option almost nobody in this group knows exists. If you are currently past your full retirement age of 67 and have not yet filed, Social Security allows you to request retroactive benefits of up to 6 months. Social Security will pay you a lump sum as if you had filed 6 months earlier. On an $1,800 monthly benefit, that is a lump sum payment of up to $10,800 with your first check. The trade-off is that your ongoing monthly benefit is calculated from the earlier effective date, meaning it will be slightly lower than if you filed today with no retroactive request. This option exists. Almost nobody uses it. If you are past 67 and have not filed, ask your Social Security representative directly whether this applies to you. Group 4. Born in 1966 or later. You are 60 years old or younger. Your full retirement age is 67, claiming at 60. To means a 30% per month introduction. Waiting until 70 means up to 24% above your full retirement age benefit. Permanently. You are not making a claiming decision yet, and that is exactly why what I am about to tell you matters so much. The window to fix certain things without it costing you money is still open, and it will not stay open forever. Your Social Security benefit is calculated from your 35 highest earning years. The Social Security Administration has been recording your payroll contributions since your very first job. That data came from your employers. And in the era of manual payroll processing in the 1980s and 1990s, errors happened. A wrong figure submitted by an employer. A year of self-employment that did not get reported correctly. A job that closed and whose payroll records weren't ever transferred to Social Security's database. A full-time work year that shows a 0 on your statement. Each missed or understated year reduces your eventual monthly benefit by approximately $100. If you have 3 incorrect years, that is potentially $300 per month less, $3,600 per year, $72,000 over a 20-year retirement, and you would never know unless you check. Go to ssa.gov/myaccountant create or log into your My Social Security account. Open your Social Security statement. Review the earnings listed for every single year you worked. Then compare those numbers against your own records. W-2 forms, tax returns, old pay stubs, anything you have from those years. If any year does not match, file a request for correction of earnings record with supporting documentation. Social Security processes these corrections and your record is updated. This correction is free. The documentation is easier to find now. Your old employer is more likely to be reachable now. Your 1990 for tax return is more likely to be where you think it is now than it will be in 15 years, right before you are about to claim. Do this now. Now let me cover 3 situations where these rules work differently than most people expect. First, the windfall elimination provision in the government pension offset. If you receive a pension from employment that did not pay into Social Security, certain state government jobs, some local government and education positions, federal employment before 1980, 2 rules may significantly affect your Social Security benefit. The windfall elimination provision modifies the formula Social Security uses to calculate your own retirement benefit, reducing it. The maximum reduction in 2020 was $587 per month, and the reduction cannot exceed 50% of your pension amount. The government pension offset reduces any spousal or survivor benefit you might receive by 2/3 of your government pension. If your government pension is $1,200 per month, your spousal or survivor Social Security benefit is reduced by $800. For many retirees, this results in 0 Social Security spousal benefit. Millions of public employees discover these provisions only when they check their estimate and find it dramatically lower than expected. If any non-Social Security covered government employment applies to you, your claiming strategy must account for both of these rules before you make any decision. Second, the claim and withdraw option. If you have claimed Social Security within the last 12 months and are now reconsidering that decision, you have a one-time option to withdraw your application completely, repay every dollar of benefits received, and restart as if you had never filed. Your benefit record returns to its pre-claim state and delayed retirement credits begin accumulating again. This option is available exactly once. It must be used within 12 months of your original filing date. After 12 months, it is permanently unavailable. If you claimed at 62 and are now 63 and regretting that decision, contact Social Security immediately. Third, voluntary suspension. If you claimed at or after your full retirement age and have not yet turned 70, you can voluntarily suspend your benefit. While suspended, your benefit grows at 2/3 of 1% per month, identical to the delayed retirement credit rate. You do not repay anything. You simply stop receiving payments temporarily and let the benefit grow. Here's the critical limitation that most explanations leave out. Suspending your benefit suspends all benefits paid on your record, including any spousal benefit your current spouse is collecting based on your work record. This is one of the most consequential and most misunderstood rules in this entire area. If your spouse is currently collecting on your record, discuss this in detail with a Social Security representative before you suspend. 3 specific actions to take before this week is over. Action 1. Log into SSA.gov and verify your full retirement age to the exact month and year. Not 66, not 67. Your precise month, if you were born in 1950. 7. Your full retirement age is April 2024. If you were born in 1958, it is August 2025. Every calculation you will ever make about Social Security is anchored to this number. Get it right before anything else. Action 2. Open your Social Security statement and compare the annual earnings listed for every year you worked against your own records. 2 seconds, tax returns. Pay stubs, anything you have. If any year does not match, gather your documentation and file a correction now, while the paperwork is still findable and the fix is still free. Action 3, and this one is specifically for widows and widowers in any group. Call Social Security at 1-800-77-1213. Ask them to pull 2 figures, your current monthly benefit amount available on your late spouse's record. Then ask directly, am I on the higher of the 2 available amounts? If you have never specifically asked this question, there is no guarantee the answer is yes. This call takes 15 minutes. It could identify thousands of dollars per year you are entitled to but are not currently receiving. If this breakdown helped you understand exactly what rules apply to your birth year, Subscribe. I publish a new Social Security analysis every week, and the rules do change year to year. Drop your birth year in the comments below and I will tell you the single most important claiming factor specific to your situation right now.